All right, in today's video and the next several videos, we are going to provide transparency on the 1-year term insurance rider. So if your goal is to take out a whole life insurance policy and you want maximum cash value, a 1-year term rider is a great rider to be aware of for a number of reasons, which we are going to cover in full detail in today's video. So let's get on into it and have some fun. If you have questions at all, please leave them in the comments below as I do monitor those, and I will aim to get back to you as soon as possible. You can also reach out to us with any questions if you'd like to ask us directly. All right, so the 1-year term rider. This is a rider that can be attached to a whole life insurance policy. And in summary, what it allows you to do is, number one, maximize the cash value. You will see on a guaranteed basis every single time more cash value in a policy that has one, a 1-year term rider attached, and then two, a minimum base premium. This has to do with the policy design feature. So number one, it maximizes your cash value. And then number two, if you do things right here, it will allow you to minimize the expenses, gain a ton of flexibility with your policy, so you never feel like you're committed to a large premium bill, and then prevent a mech from occurring. So let's get into details here. Number one, what we want to touch on here is who uses it and who has used it for a number of years. Corporations heavily use this 1-year term rider, meaning when you look at whole life insurance policies that are purchased by corporations, when they're taking policies out on their executives and or employees, the policies are owned by the corporation and the cash value is an asset on the balance sheet. What corporations are very concerned about, when I say corporations, I'm talking about large and small, they're very concerned about a life insurance policy anywhere they're putting money, not negatively impacting their profit and loss statement. They don't want to take a hit on that balance sheet. So what a 1-year term rider allows them to do is reduce the overall expenses on a whole life insurance policy and stuff more money toward that PUA rider, the paid up additions rider, which is the best means to accelerate the cash value growth on a whole life insurance policy. So it has been used for a very long time with corporations. And when you look at wealthy individuals who treat their personal balance sheet very simply, they treat their personal balance sheet a lot like a corporate balance sheet, you'll see the exact same thing implemented. How do I minimize expenses, maximize cash value? Because my goal is to maximize the cash value of this whole life insurance policy. That's why I'm doing it. Some other things here. What do we see here? Why? So why corporations and wealthy use this? We hit on the first point being an asset on the balance sheet. Number two, strongest guaranteed and non-guaranteed values. What you will see on illustrations. So if you're looking at a policy and you're comparing policies with a 1-year term rider to policies without a 1-year term rider, what you'll see every time is the strongest guaranteed values. As long as there's no manipulation going on with the illustration, which happens sometimes in the industry where someone will try to leave a 1-year term rider on forever and say, look at those expenses go up. We'll show you how you can easily remove a term rider. If you do everything properly and you're upright as an agent, meaning you're showing here's how to truly maximize everything while playing within the rules of the game, what the insurance company offers and the IRS offers, you can optimize a policy and you will see every single time, based on the guarantees, the strongest overall cash value. Non-guaranteed values on an illustration, the majority of cases you will see with a minimum premium and this 1-year term rider attached, you'll see more cash value in the majority, 90% plus of cases. In reality, actual performance, policies that have lived the test of time, we've always seen stronger cash values with minimum base premiums and these 1-year term riders attached. Now, here's another reason corporations do this. It allows them to commit to the minimum premium and have the ability to add more funds into PUAs. So they're minimizing their commitment, minimizing their expenses. I'll explain exactly how that works when I keep on saying minimize expenses. I'm going to show you that in a second. But then also maximize the flexibility. What I mean when I say maximize the flexibility is if a corporation wants to pay in $1 million per year, let's say it's into whole life insurance policies on 5 executives, often they set it up in a manner where they say, okay, we can hit the $1 million per year We're fairly confident of that. But if there's an event where our cash flow tightens and we can't get the full dollar amount in, the full million this year, what happens? Well, if a policy is properly designed, what happens? We can set it up where they are only committed to, call it $100,000 per year, with the ability to add up to $1 million per year. So having a minimum premium and also having this 1-year term rider allows them to reduce their commitment, minimize expenses by reducing that base premium, and shove money into cash value to that PUA rider, which accelerates the cash value at their discretion. You can do a lot of damage in a good way with it. But that's exactly how they optimize the flexibility on a policy, and a 1-year term rider gives them that flexibility. Commit to the minimum, add more discretion with some companies. All companies have different rules. Another piece here I want to touch on. When did companies begin offering this? Early 1990s. So I actually heard this from a contact at MassMutual when I asked about it several years back. Early 90s is when they came up with, this is specific to MassMutual, what is called their SIPR rider, which today is LISR, which is their 1-year term rider and PUA rider. Early 90s, I believe it was in 1994. What is so interesting to me about that is, when was the MEC law passed? 1988. Why was the MEC law created? Because people were using cash value life insurance policies purely as a place to store a ton of cash and access that cash. It was being abused from the viewpoint of the IRS. Cash life insurance, that is, was being used for cash value, not for the death benefit. So the MEC law was created. However, you still had that attraction to cash value life insurance. When you look at a whole life insurance policy, it is what? A safe, liquid, tax-free area to position money. How do I make that policy, once the MEC law is created, as an insurance company, think of it this way, how do I, the insurance company, make the product attractive so I can still capture those corporate sales which really drive revenue? I'm talking about specifically corporations that take out whole life insurance policies for their executives and employees, not a pure corporate-owned life insurance or bank-owned life insurance product, as those are different. Those are single premium MECs. But with this market, what they did in the early 90s, they said, okay, a way we can increase our PUA limitations without triggering a modified endowment contract is by adding a term insurance rider to a policy. Now, we have level term riders, but a 1-year term rider provided a ton of PUA flexibility, which is appealing to corporations. So it's a nice option that was created and has really been used heavily since its inception. So let's continue on here. What do we have next? Design. So the example I mentioned I would hit on here. So how a 1-year term rider is set up with a dividend paying whole life insurance policy. My favorite thing to talk about, the design of a life insurance policy. Let's assume you want the ability to fund up to $100,000 per year. So you want the ability to pay $100K per year, not the commitment. You do not want to be billed for $100,000 every single year. What a lot of people do in this case is design a policy as follows. Let me set the premium at the absolute minimum. So assuming we're with one of the major mutual companies that have right around a 10% minimum premium requirement, if I want the ability to pay in $100K, I would set it up with a $10,000 minimum premium. Base premium dollars with a traditional policy typically do not generate any cash value in the first year, sometimes the first and second year. Let's assume that that purchases you a death benefit of $100,000. And we'll assume that gives you a MEC limit of $15,000 to $20,000. That MEC limit, we don't want a taxable event. If your policy becomes a MEC, the tax-free benefit is out the window. So what we do here, in order to raise the MEC limit, how you do that is by adding more life insurance. And you can increase the life insurance amount by increasing your premium, but that's a higher commitment then and less money that does not show up in cash value in the beginning. Or you can add term insurance to the policy. So here's our 1-year term rider. These are round, simple numbers in this example. Term premiums build zero cash value, so it's a pure cost. However, it is a minimal cost. Let's assume in this example, it gives you another $2 million in death benefit, which now raises your MEC limit to over $100,000. Now all of a sudden, you've got a premium where you can commit to the minimum, which would be that base premium. In addition to that, the cost of the 1 year term. So it'd be what, if you add those two together, about $11K. And then 100% at your discretion, you can just pour more funds into that paid up additions rider. I should rephrase, when I say 100% at your discretion, depends on the company you select. Some companies have very, very flexible PUA provisions where you can just add money anytime, and some companies only allow you to make adjustments one time per year, and some companies are not flexible. But with that PUA payment, goes into the policy. I see it show up in cash value. Typically in the first year, you're going to see between 90 to 95% of PUA dollars show up in cash value. That's money you can access, begins compounding. This is the key to accelerating the cash value. Going back to that corporate design, what happens here? Well, this is the asset in the balance sheet. This does not show up in cash value, the premium piece, therefore they want to reduce it. PUA dollars do purchase you some life insurance. It is good to be aware of this. And you'll see why when we look at how the 1 year term rider actually functions, how it works. But it does purchase you paid up additions. When you add funds into PUAs, it does purchase you more whole life death benefit. Important to be aware of that. So, big advantage there is policy flexibility. Let's continue on here. How it works. So, a 1 year term insurance rider, what it is and how it works. It is a term policy, so you've got additional death benefit on your policy, and it is annual renewable term. What that means is each year as you grow older, the cost increases. Now, an additional side note here is that it is important to look at the current expenses. When we look at the major mutual companies, that's typically where the expenses are run and have been run at a long time. The same is true with smaller companies too. But if we'd like further transparency, it never hurts to look at the guaranteed expenses. And if you really want to look at a worst case scenario, you can look at the guaranteed expenses with no dividends ever paid, just the guaranteed rate. And that's a worst case scenario. But it is good to look at that kind of stuff. I like looking at it for two reasons. One, to MEC test a policy, or one MEC assumption, I should say. And then two, to see how that product performs if everything just stays horrible forever from the insurance company's perspective. Is it still the best overall design if my goal is to maximize cash value? But it does not hurt to look at those, and we're going to look at those as we progress through this video and the next several. Now, we mentioned that it is annual renewable term insurance. What that means, again, is each year as you grow older, the cost of that term insurance, whatever that death benefit is, increases over time. However, there is a catch, and it's a good one. The term rider amount will decrease as the years pass. It'll decrease as you add money into your policy. And this results in a cost decrease. If you have less term insurance on the policy, naturally the cost will be less. So if you start out with a $1 million term rider, and then 5 years later it's $500,000 or a lesser amount, obviously it will cost less because you're only paying for whatever term amount is still attached to the policy. Let's demonstrate that point because that can be a little confusing sometimes. Let's assume day one, you start out with a whole life insurance policy, you purchase it, you want maximum cash value, you're gonna stuff this thing and use it for all sorts of good stuff. And the design looks like this. Your whole life death benefit, which is generated from your base premium, is $100,000. You have a term rider attached for $900,000. Add the two up, you have a total death benefit of $1 million. That's day one, let's call it day zero, before you pay a penny into the policy. So as the years pass, you are funding this policy. You may fund it according to plan. You might not. Things do happen over time. But here's what I want to touch on. Remember the policy design piece where we talked about that PUA rider when we've got that $90,000 payment and buys us almost another $300K in death benefit? Here's how the PUA rider works. So everyone always thinks about the PUA rider as a means to accelerate the cash value growth because that's exactly what it does. So in this example, let's assume you make a $1,000 PUA payment. What shows up in cash value is $1,000. It might be $950 after the initial fees, but it will compound and surpass the $1,000. But I think you follow my example. PUA payment $1,000. I've got $1,000 in cash value. That buys me another $3,000 in whole life death benefit. Whole life death benefit, which is this guy up here in purple. Okay. Another thing to be aware of, when dividends are paid to your policy, let's say you receive a $1,000 dividend. Dividends are often reinvested into what? Paid up additions. That's the most efficient way to grow the cash value of a life insurance policy. If you have a 1-year term rider attached, the dividend option will usually read, it's got different terminology. Sometimes it's flex or option Q, depending on the company. Typically, it'll first cover the term charge, especially if you're not covering out of pocket, and then everything else goes into PUAs, paid up additions. But what happens here, so a dividend of $1,000 is paid, just like a PUA payment you would make, shows up in cash value, which buys you more whole life death benefit. So as you add funds to the policy, your whole life death benefit goes up. As dividends are paid, your whole life death benefit goes up. So how a 1-year term rider works is like this. As that whole life death benefit increases, the term rider decreases, and it decreases proportionately. Let's assume in this example, you funded your policy, you started to receive dividends, your whole life death benefit at the very beginning was $100,000. Now what is it? 5 years later, it has appreciated to $500,000, which means that term rider, which day one was at $900,000, has now dropped to $500,000, keeping your net death benefit level at $1 million. Depending on the company, there's ways you can have a 1-year term rider and have an increasing death benefit. We'll touch on examples of that as we progress through this video series. Point here though, what do you notice? As you add money to the policy, as dividends are paid to the policy, your whole life death benefit goes up and your term rider comes down. So to wrap this piece up, the catch I mentioned earlier, as the term rider decreases, the actual death benefit amount decreases, that will offset the costs. When I say offset the cost, because the cost of actual term insurance goes up each year, the fact that the term amount is going down, that means your net cost will often come down, which is what we want. So let's continue on here. Very fun stuff, right? Flexibility. This is one of my favorite things with a 1-year term rider. Adding a 1-year term rider will more often than not open up a ton of PUA flexibility. I'll give you one example. Take Guardian, good old Guardian, one of my favorite major mutual insurance companies. If you do not have a 1-year term rider attached, Guardian's PUA language states, this is in their contract and company memos, it states that with the exception of the first year, you can add a maximum of 3 times your base premium into PUAs per year. So what that means is if you have a $10,000 minimum premium without a 1-year term insurance rider, the maximum PUA payment you can make each year without underwriting would be an additional $30,000. That's the max. However, if you have a 1-year term rider attached to a Guardian policy, the maximum they will accept and even allow us to illustrate is 10 times your minimum base premium in PUAs. So in that same example, if you have that base premium of $10K and we've got a 1-year term rider attached, now you can add an additional $100,000 per year into PUAs, which will accelerate the cash value growth of your policy dramatically. You'll see stronger values guaranteed, non-guaranteed, an earlier break-even point, which a lot of business owners and real estate investors we work with, they're very, very concerned about maximizing that upfront liquidity. They get the long-term benefit. They see that, hey, I got that. I'm sold on that piece. Get the upfront cash value stronger so I can use this. I might not even need it, but in the event something happens, I want access to it. So that's one example referring to Guardian there. And then it also opens up additional flexibility. If you take Mass Mutual as an example, it allows policyholders to adjust payments every year without underwriting on their anniversary date. So let's hit on a quick cost disclosure here. And these are examples we will heavily reference in the next couple of videos. But when I say cost disclosure, all companies have a different way of actually disclosing their 1-year term rider charges. So here's an example we're going to reference several times with Guardian. 40-year-old male, 7-pay. So funding it for a short period of time, just max funding it up to the MEC limit and then shutting it down after 7 years. So with this example, we see the premium, there we go. But then we see right here, target additional benefit. There's your actual term rider amount. This is day 0. And then this guy, OYT, represents 1-year term. You'll actually see it over here. That's the term rider cost. Now you'll notice that the term rider in the first year here is 1.57 million. However, up here it's 1.827 million. Why we have a difference? So remember when you add funds into PUAs, what happens? PUA dollars, we do it for cash value, but it also gets us more whole life death benefit. So here's our PUA payment. This column right here represents the additional whole life insurance, the whole life death benefit, is $256, that your policy has increased by. So that $272 on day 0 has now increased by over $250,000. And you can actually subtract that $256 from the $1.8 million, and that's going to give you that $1.57 million figure. And what happens there is as the term rider comes down, the actual death benefit, the cost comes down. Now, how Guardian discloses the costs, they do give the exact dollar amount in the first year, but then they give you this formula, which makes it very fun, right? Imagine if I just sent this to you saying, see attached. Like, all right, what am I looking at here, bro? Like, this is not easy to follow. So you see current OYT cost, 1-year term cost, /1,000, and then guaranteed OYT cost per 1,000. What this means, we see 40 cents in the first year. That means for every $1,000 of term insurance that is attached to the policy, the cost is 40 cents. You'll notice in this particular case with Guardian, the costs are guaranteed not to increase in the first 2 years. However, beginning year 3, if we look at their current cost, which is what they have assessed for a long time, there's what it is. Or that's what it is, I should say. And then here is the guaranteed maximum. Meaning if the company wants to increase the costs of the actual term insurance rider, that's as high as they can contractually raise it. So what we do, because it's for every $1,000 of term insurance that's attached, there's the actual dollar cost, is just take the dollar amount there, multiply it by that dollar amount. You have to input the proper formula, so it's actually based on 1,000. You need 3 zeros before that decimal there. Let me just show you real quick. So we're going to come back to this. Here we go. So you'll notice here, we've got that same illustration up. There we go. So there's the term rider. We just pulled this data from the illustration. There's the term cost in the first year, and then you can calculate it as the years pass, which is nice. And you'll notice when the guaranteed costs kick in, year 3, you do see a jump there. However, in this example, we're heavily funding it, and we quickly buy down that term, and this is even based on the guarantees. Interesting stuff, right? So that's a quick example on Guardian. Then you can look at other carriers. All companies have different ways of doing things. If we take a look at Mass, so here are their current costs. So when we see outlay current values, we see Lister term charge. This is their 1-year term rider. And here you go. So this was a case where we wanted to illustrate funding up until the age of 65, so for 25 years. We ran another scenario where we funded it for 50 years, right? Going for a very long time. If we want to fund a policy for a long period of time, and we want a 10/90 split, can we fund for a long period of time? The answer is yes. So we've got to keep that term rider on, and that cost will gradually increase over time. We're slowly buying down the term, but it does increase. And really what we want to look at here, well, we could just look at the guaranteed and non-guaranteed net cash value, but if you want to see the cost, here's what we want to look at. Give it a minute. There we go. So here's midpoint values. This is a conservative cost, or I should say this displays a higher cost than what the current costs presently are. You will see it higher. And if you want to look at the worst case scenario, here we go. One too far. There's our guarantees. So what you'll see as we actually break down these policies and compare them to policies with and without term riders is exactly what we just saw there. So we like to extract all of that data, make it very simple. When we look at the actual OYT costs, there we go. And we'll come back to this. So you will see case studies as far as policies with and without term riders throughout this video series. But that is really how we obtain the cost disclosure. We want to request it on the illustration when you're working with your agent, if you're working with us. We just want to request that information and always make sure that everything is fully transparent and done correctly, such as after the funding, the term rider is being cut. If you hear, oh, you can't cut it because it will MEC, well then cut it a few years after the fact and it will not MEC. It's easy to set up a policy properly. You just have to know how to do so properly and be willing to do so properly as an agent. Let's continue on here. So what is the risk to a one-year term rider? We sometimes get this question, and here's my short answer. So in summary, if we're not going to go through the data, what is the risk to a one-year term rider? I would refer to it as neglect. The agent is neglecting your policy. You have a policy where you plan to max fund it. You underfund it. You never get the maximum in. You fund a significantly lesser dollar amount than what you had planned on. And then that term rider cost, remember when you fund less, when you pay less into the policy, less goes into PUAs, which means what happens with the whole life death benefit doesn't increase as much. So your term doesn't come down as much and it becomes more costly. So if that went on for a very long period of time and the agent never looked at it, meaning they don't do any reviews, they never reduce the term rider, which you can easily reduce it, they never remove it, which is very easy to do, that's where we could run into a risky situation. It would be like having a car and never taking it for an oil change. This is why review meetings are important, and it's also why our company is very, very, very big on service. If you work with us, you know that we're always reaching out to you every 6 months. So the risk here, term rider costs do go up over time as it is annual renewable term. And then here, if PUAs are not added, what happens? The whole life increases slower than anticipated. And it can get expensive. Or it will get expensive with the term insurance rider. Now here's the easy solution, which we touched on briefly earlier, which is as follows. Reduce the term rider. Did you know that if you have a one-year term rider attached, you can reduce it? So if I start out at $900,000 and I underfund the policy, I can peel off $200,000 or $300,000 of that term insurance rider. And I can do that every year if I wanted to. By reducing that term amount, what happens to the cost? Well, I reduce the cost as well. So it's a nice way just to reduce it. Why I might want to reduce it is because remember, if it's added, I've got that flexibility in most cases to really pour money into PUAs. So if we had a conversation after you've had a policy for many years and you said, you know, I plan to really pay a lot in, but it didn't quite happen. I think I might be able to add money down the road. I'm going to sell a piece of property. I'm going to have a huge sum of cash. At least I think I will. I'd like to throw it into the policy. And I don't want to have to go through underwriting because I have a health issue or just be a pain. Well, if you have this rider attached, guess what? You can easily do that. So that's where we would reduce it. If you feel, hey, I'm going to throw a ton in, I might look at it and say, we might not want to reduce it because if we cut off too much, you won't be able to get the full dollar amount in that you'd like. Just looking at it and analyzing it is my main point. Or what we can also do here is remove it. So you can cut it off altogether, and what happens at that point in time? The cost is gone. Very easy to remove. We just want to have the awareness of that flexibility provision. And also, here's like the easy part here. We can look at the guaranteed values. What do the guaranteed values look like with that term rider attached when we're underfunding it, when we're max funding it, if we partially reduce it. A couple extra steps on the agent's part, but that's it. Like we can request that information. And this is just a personal feel of mine. Never be shy or never feel like you cannot request multiple illustrations or multiple scenarios. It's your money going into a policy. So you really have the right to know what's going on with your money. Request as much information as you need. That's if you're working with us or anyone for that matter. So the specific question we sometimes get here is, which option gives me more money? If you're a policyholder, if you're looking at a whole life insurance policy, or if you have one already, will you have more cash value, short-term and long-term, if you have a one-year term rider attached, or if you don't have a one-year term rider attached? To be more specific, sometimes we do receive this: does it make sense to go with a policy that has a higher base premium without a one-year term rider, or do I go with a policy that has a low or minimum base premium with a one-year term rider? Which one will give me more money? And how do I determine that, right? How do I have full transparency and make sure I don't fall into any traps down the road? Well, measure the costs. And I like this illustration of the horsepower test. Vroom, vroom. In order to test the horsepower, we can do two things. We can take it to a specialist. They can run a test on our automobile, see how much horsepower we have, how much we can potentially add, because they're a specialist when it comes to cars and motors. You can tell I like cars. But we can go through all of those extra steps and get to see exactly how much horsepower my car has. I purchased it. It had 500,000 over the years. I see it only has 440,000. Time for a tune-up. How can I improve it? Takes a lot of time. Takes a lot of work. Right? Costs more money or more time. Or I can just floor it. Does it get me from 0 to 60 faster than my neighbor because we like to race here and there? I'm not saying speed on the highway, but you know what I mean. I can just floor it, or I can take it in for a horsepower test. So how this relates to a one-year term insurance rider. I can look at all of the details just like we referenced there, and we will look at examples in the next several videos, or I can just look at the cash value. The net cash value on an illustration, and we've got here, look at the guarantees, but this is true of the guaranteed and non-guaranteed values, do reflect your base premium expense, term rider expense, PUA rider fees, all the expenses that are associated with your policy. The net cash value factors them in. So the simple comparison is just to see, okay, which one gives me more money? Like at the end of the day, I can just floor it and see which one gives me the most cash value, which one provides the most flexibility. And this is if I'm paying equal dollar amounts into the products. And then what does it look like if I take my foot off the gas? If I can't pay quite as much in, I've got to peel back some years, then increase my payments again. We can look at all of those scenarios. So we can look at the details or just look at the guaranteed and non-guaranteed values to see which one has more money at the end of the day. That is the easy part. So in this video series, we are going to look at different companies, different products, different funding periods. We're going to hit on some different designs that we often receive requests on, which are as follows. This will be a lot of fun. 1090 designs with a one-year term rider. We get questions if it makes more sense to have a level term rider with a design around a 30-70 split. So we will look at that. And then we'll also look at a 60-40 design with no term rider attached. And those splits are not specific. Sometimes you will see a clean 1090, sometimes it'll be a little bit less. Sometimes the 60-40, with one example, we had to raise it to about 63%. Same thing with the 30% base premium was about 33%, just the minimum amount to prevent a MEC from occurring in all cases. But we're going to look at different splits. We will analyze the guaranteed values and non-guaranteed values, so you've got full transparency there. And then we'll look at short and long funding scenarios. With the long funding scenarios, the splits will be around a 45-55. Only because of 40-60, you could make it work, but if you wanted to keep funding for a long period of time, you would run into a MEC just with the different companies we put together. So what we did, instead of shorting the funding period, we increased the base premium, which increased the death benefit, which increased the MEC limit. A lot of info. Hope you enjoyed this video. If you did enjoy this video, please hit the like button, subscribe for more. If you have any questions, again, feel free to leave them below. I do monitor the questions. And as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.